Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for April 14th of 2024. Well, we certainly have a lot of inflation data to go over with you this week. We had both the Consumer Price Index as well as the Producer Price Index released over the last 7 days. And and just very interestingly enough, the CPI came in hotter than expected, and the PPI came in a little bit lower than expected. And so here we'll start off with the CPI, Consumer Price Index. This is the monthly data, and you can see here very clearly that the estimate was for inflation to be up 0.3% for the month, and it came in a little bit hotter than that at 0.4%. You can see here the trajectory of overall inflation. You've got all items, so this is the all-in CPI in the black line here, and you can see here just lately, over the last call it 6 months or so, we've had this general uptick. I'd say, we'll look at this in some depth later, but for a while we had this general downtick, and this is monthly data. So again, this is not year-over-year data, just to be clear. But we did see some lower data points here in 2023 that gave us a lot of room for optimism. And of course, lately we've had 3 straight months of numbers that were higher than expected. We'll see that in a second. Actually, we've had 4 straight months of higher than expected numbers. But all in, inflation is just running a little bit hotter than normal. We can see the derivation, some of these items up here in the legend. So really, we're going to talk about this too. I mean, it's not goods inflation, it's services. And that's represented here in that blue shaded area. You can see energy did contribute a little bit. We see energy prices moving higher. Food, not so much. I think we've kind of seen a lot of those headwinds and food inflation go away, and then in core goods, as we'll see very, very poignantly here in a second, we're actually at a point of disinflation. So you look at the reasons behind inflation that we're seeing right now, it's all in the services category for the most part. Here we have data from Bloomberg, and this shows you in kind of the aqua line here that this is these are the actual CPI year-over-year numbers as we were looking, like say back in October, 3.2, going down to 3.1, and then December, starting in December, we had higher observed year-over-year data based on the monthly numbers than was expected, as all of these black bars represent estimates heading into the release. And so you can see clearly here December, January, February, and March, all ahead of expectations. And so this is this body of data here that's getting the market a little bit nervous, and it's taken a lot of steam off the arguments about lower overall interest rates over the balance of the year. So as long as we have these kind of not only in the aggregate higher numbers, and you can see here that we're on a year-over-year basis now looking at 3.5%. And of course, the Fed wants it down close to 2%. And I think what we're probably facing with all of this data is, one, an acknowledgement that the Fed is going to take a while to get to 2%. And they might actually accept something that's a little bit higher than that overall, because they have a dual mandate of prices and full employment. And obviously you have to, prices tend to be influenced by what happens with unemployment. And right now, employment's fairly strong. We're going to talk about that in a few minutes. But clearly, last 4 months, we've had higher than expected data, which has led to higher overall inflation, which has led to this perception that we're going to have fewer interest rate cuts this year. Now we'll look at a couple of reasons why we had higher services inflation, and this one is a year-over-year number for motor vehicle insurance. You can see that this we've had a really strong rise in insurance rates over the last year, and obviously that's something that hits just about everybody in the pocketbook. And then we have monthly data for hospital and related services, and we know healthcare oftentimes runs from an inflation perspective hotter than the overall rate of inflation. But here lately, we've seen a couple of data points, monthly data points that have been really strong. And so when you look at 1.2% just for the month of March, and that's just for the month of March, whereas motor vehicle insurance is up 22% year over year. Those are pretty outstanding numbers in terms of their size. And again, two of the main reasons why we saw such robust CPI services related inflation this past month. We'll talk about core prices here. We've got the CPI core. This is the monthly data, right? And then here is the year-over-year data. And so we look at the monthly data, and you can see, there's clearly been a deceleration of sorts. If you look at it on a trend line basis coming out of kind of the pandemic-related adjustments that made 2020 exceptionally noisy in terms of inflation. But once you get to that peak inflation, I mean, we are witnessing a monthly downtrend, as you are here on the year-over-year number. That's been coming down. Of course, during this entire trajectory, the expectations were building, especially when we got down to here on core year-over-year being around 4%, that we were going to get some rate cuts this year. And at one point, it was like 6 rate cuts. And we'll show you in a second how that has dwindled to maybe 2 at the most right now. And we're not even through April yet. But as you can see here, that on a year-over-year basis, that this rate of deceleration has kind of attenuated, and then we're still going down, but it's kind of leveling off here. And so that's, and I would say that, inflation cycles are never perfectly linear. So, I mean, it wasn't realistic to think that you're going to go from here straight down to 2 without some type of, hiccup. We saw a little hiccup here, and it just happens this way. And, over the last 6 months, we've had an uptick in overall monthly inflation, but it hasn't yet completely broken this downtrend that we've seen over the last, really over the last 3 years. We'll talk about the difference between goods and services. We've already shown you basically healthcare and auto insurance. I'd put insurance in general in that bucket right now, but that falls in the services inflation. You can see the monthly data here has been pretty strong on a consistent basis, and this has been a real source of stubborn influence in inflation. And this has been a stubborn influence on that inflation, is what I was trying to say. Whereas goods prices have actually been in deceleration for the better part of the last year, with only one small uptick here. But then, when you look at everything in balance, you balance out services with goods, and we're still witnessing inflation that's higher than where we want it. And it's largely because of this right here. We talk about other elements of the service inflation basket, and here's a big one. This is the rent of a primary residence. You can see that we have come off our peaks, although the last couple of data points, again, the downtrend is fairly well established here. However, the last couple of data points have been higher than expected, and it was up 0.4% last month. Now, and this is an observed number right here. This is an empirical number, the owner's equivalent rent, and it was also up 0.4%. Again, same general downtrend from the peak, but it's just stalling out. We're kind of flatlining, if not like moving slightly up. And so what we do know is that like observed rents for multifamily are in decline, and those things tend to work at a lag to what is observed in these numbers right here and what's calculated in these numbers. So I do feel like these are, both of these data points are apt to go lower in the coming months as this data catches up with what we're seeing in observed rents, at least in the multifamily sector right now. Now we will turn our attention to producer prices. Here's the producer price index, PPI. This is the monthly data. We've got two monthly data series here for you. Here's the overall PPI, which, as I mentioned at the outset, was actually lower than expected at 0.2%. And the core PPI was also in line. Well, it was in line, but it was also 0.2%. And you can see that, this has been, a non-consistent, certainly non-linear inflation pattern, as we know that, manufacturing was in a bit of a sector recession, and we still have relatively weak manufacturing numbers. So producer price inflation, after we got through with all of the commodity price and supply chain constraints here, that really has been mostly benign, even though the last monthly data point was an uptick, as it was on the core as well. And you can see general downtrend here. It was really January that surprised a lot of people, both as we look at the all-in as well as the core, because that was higher than expected. And it's just that we've had some pretty low data points here over the last year, and so to see this kind of pick up a little bit was a bit concerning to some. So it hasn't established a firm trend yet. It's worth watching, but the good news from a sentiment standpoint is, while we entered the week and we have the consumer price index numbers that were hotter, caused a kind of a bit of a upheaval and volatility in the equity markets, and certainly volatility in the fixed income markets, that we then followed that up with a PPI number that was lower than expected. So getting back to the expectations on interest rates this year, this chart really does a good job of kind of giving us some perspective on how quickly that sentiment has changed. As you look here, at the end of last year, we're looking for basically about 1.5% worth of rate decreases for 2024. Again, this is market pricing for rate changes in 2024. And again, back at the beginning of the year, end of last year, it's about 1.5, and you divide that by quarter point increments, and that was market basically expecting 5 to 6 rate cuts over the course of the year. And you can see how quickly and how violently this has reversed itself. And so now we're expecting basically, right now expecting one full 25 basis point cut, or 0.25% cut, and then maybe a little bit more. So bottom line right now is we've gone from essentially 5 to 6 rate cuts down to maybe 2, which is, from my perspective, something that I was expecting all along. I never was under the impression that we were going to get like 6 rate cuts this year, because the economy was just simply too strong to make that kind of conjecture. Now, of course, I would say that with short-term interest rates being higher than the rate of inflation, even though consumer inflation was a little bit hotter this time, that makes credit inherently tight. And so there is a case to be made on its face for the Fed to lower rates, but what you don't want is to reignite inflation. That would be the worst case scenario, is to have inflation go back up to 5%. That would be an environment where the market would clearly not react well, and I think that would be a scenario that would push us a lot closer to a recession, when we have an environment right now that I think the soft landing is like entrenched at this point. So looking at this a different way, you have a chart of expectations, essentially looking at this forecast as we look out through the end of 2024 into 2025, and look at the end of 2025, and you can see where we are now in terms of the forecast relative to where we thought we were going to be entering the year. And so you can see that depicted in this dotted blue line, and then this kind of this red line here, if you will, represents the current market expectation. Again, higher for longer, and not getting as steep or as quick a rate decrease as we thought. Now, the trajectory on both of these is clearly down. And so if you look at by the end of 2025, markets looking at 4% on Fed funds rate, whereas it's now about 5.25%, but at the end of this year, again, the market's looking for maybe 25, maybe 2 rate cuts right now, whereas previously, from where we are, they were looking for at least 1.25 to 1.5 percentage points of rate decrease. So we'll continue to monitor this, but obviously sentiment can change again fairly quickly, but right now definitely higher for longer. So with the higher for longer thesis comes a stronger dollar inherently. If your interest rates are going to be higher for a longer period of time, that is inherently going to add strength to your dollar, and that's exactly what we've seen here. As you look at this chart, it goes back to basically May of last year, but if you get to December and kind of like the first quarter of this year, you can see that we've gone, that we've increased by, about 6 percentage points right now. So, and this is volatile. We're not nearly back up to our peaks from the third quarter of last year, but we've certainly come a long way since the beginning of the year. And this is measured by the DXY, which is essentially the dollar measured against a basket of currencies. And so you can clearly see that that's moved higher. And so when you think about this, U.S. has higher rates for longer. Rest of the world is trying to figure out its policy. We still have, some countries, central banks in some countries that are still easing. They're wanting to rejuvenate their economy by making credit a little bit easier. But they're doing that right now at the risk of some massive devaluation in their currency, because our rates being higher is leaving the dollar a lot stronger, as we can see here, which if you're looking at emerging markets or even other developing markets like Japan right now, who just raised their rates, their short-term interest rates for the first time in 17 years, we're essentially exporting inflation to those countries that have currencies that are devaluing relative to the dollar right now. I want to show you this that is not getting as much press right now, but I think once we kind of firmly establish ourselves in a new economic cycle, and we do have some rate cuts that will manifest and kind of filter their way through the system, I do think the calculus is going to return to this issue right here, and this is the national debt, which you can see here, as of September 17, we were at 20 trillion. We're doubling that in 8 years, and by the second half of 2025, this estimate is looking closer to like $40 trillion, and obviously that's an unsustainable pace. If we want to continue to grow the economy on a reasonable basis over time, if you have more national debt, obviously you're paying interest on that debt. And if you have higher interest rates than we had over the last decade, then that means a higher interest burden, which then crowds out other government-related investment and infrastructure spending and things like that. And as most of you know from listening to me talk about this a lot, that that government spending component is a meaningful component of overall economic growth. So the equation for basically GDP or economic growth is consumer spending with net investment, with net trade, and government spending. Those 4 things make up GDP. And so if you've got this issue of crowding out, where you've got more debt that you need to pay interest on, it's going to leave you less money for other things. And I think this is something that, once we get past this election, which will be supercharged, we've got to turn our attention to our fiscal deficits and dealing with this debt issue overall. Now I want to talk about a couple of surveys, this being a Gallup poll of individuals. So we do know that, looking at individuals, they have been, these are the people that have kind of like basically been on the front lines of of the observed inflation, whether it be gas prices, food prices, energy prices, you name it. And they've seen it. And so what this survey is telling us is that for quite some time now, we've had kind of a subdued confidence index. And again, we talk about confidence at many levels. You know, you've got large company confidence, which is actually reasonably good right now. You have small company confidence, which is also very subdued, and we'll look at that in just a second. But then you've got this consumer confidence that is embedded here. And even though you've got strong labor markets, relatively speaking, you have positive or real, wage growth. Consumers are still feeling this, and they obviously now they're, as we just talked about, they're dealing with higher auto insurance rates and higher healthcare costs and things like that, and so that puts them into this pickle of sentiment right now. We have small businesses too. We've got several small business indicators coming at you, and we'll talk about the overall small business sentiment in a second, but this is actually a really good proxy for that. And this is a chart from Bank of America Global Investment, their strategy team, and you could see that that is coming down after a prolonged period of increase. And so this is basically more than a decade's worth of continued increase in percentage of companies that are increasing employment. So we saw a really tight labor market manifest out of all this. And as we do know, small business is the horse of economic growth for America. Large companies get all the press, and they are big, there's no doubt about it, and influential, but small businesses account for the overall, overwhelming majority of economic growth in this country. And you can see here that after a long period of increase, now we're on the decline. This number correlates pretty tightly with this light blue line, which is the quits rate. So when you have hiring intentions continuing to move higher, you tend to have a lot more labor mobility, and so people are able to quit their jobs and go work someplace else. Well, that's now actually been in reverse for a couple of years, and so even though the labor market's pretty strong right now, what we're seeing here is clearly small businesses being a little bit more conservative in their employment expectations. Here we have the NFIB Small Business Optimism Index. That stands for National Federation of Independent Businesses. You can see here that the Optimism Index in the March survey was a little bit lighter than expected, and you can see the overall trend has been down. And again, if you look at the pandemic, that caused a distortion here, but this post-pandemic overall trend has been down. And so, again, small businesses are less optimistic than large ones. Larger businesses tend to have better access to capital. They're better insulated from a financial stability standpoint. They tend to have more standby cash or working lines of credit they can draw on. Smaller businesses tend to be more influenced by interest rate changes and access to capital and those types of things. And so, this has been kind of a trend in the making here. And we also look at sales expectations being a bit subdued, and as we just saw, hiring intentions going down as well. And so, this is real data. Obviously, these are surveys, but they're, they reflect an attitude that exists out there. It's not something that happened overnight. So this has been in motion for a while, and you can see that, the optimism index had a downtick in the last reading, but it's been kind of like range bound here for a few months prior to that. And I think it'll take those rates coming down and capital being more accessible and overall cost of credit being cheaper for these small businesses for them to get a lot more optimistic. So we've got a comment on labor. We showed you this chart not too long ago, but it's worth going over again. So black line represents initial claims, and so this has been pretty noisy. And outside of a little bit of a bump here in the middle of last year, we've really been kind of range bound. So this is not symptomatic of a pre-recession environment. This is actually more symptomatic of a pretty tight labor market, to be honest with you. And so on the right-hand scale, these are the initial claims, and anything I think less than 250, is pretty good, because you're bringing new entrants into the workforce, and at the same time that you've got other people that are maybe transitioning out, and so you're replacing workers at a rate that's in line, if not greater, than the ones that are going on initial claims. Now, look at this other line here, and this represents the continuing claims, and so this is represented on the left-hand side of the chart, and you can see those going up for quite some time, and then we saw that uptick at the beginning of the year, but it's actually really leveled off, and you go back to essentially the third quarter ish of last year, and continuing claims have been really flat at a time where initial claims have been pretty flat. Quick check-in on 30-year fixed conforming mortgage rates. As you see here very clearly, about 7.4%. They have come up quite a bit in a relatively short period of time, and that's because because of this higher for longer issue. We saw with some of the inflation data that intermediate term interest rates have moved higher. We're probably closer to 4.5% on the 10-year, which is a big reason why we've got 7.4% on the 30-year fixed mortgage rate, which tends to follow and track and be indexed to the 10-year U.S. Treasury. Talk a little bit about commodities, because we've really seen an outstanding performance on the part of commodities this year, and precious metals is, I think, in many respects leading the way. And you can see this chart here, in this dramatic rise in gold prices, but gold hasn't been the only precious metal. We've also seen silver and some of the others follow the same path. Gold has come a long way, and if you look at, like over a longer period of time, this only goes back basically about a year. But if you go back farther, then you're much more range bound between call it like 2000, 2050, and like 1800. And we were kind of range bound here for a while, and then started to pick up in this, looking at the trough of the market back in, like October, we've seen a dramatic rise at 2400. Now, I don't know how sustainable this is. Obviously, interest rates, inflation, it all feeds into gold. But again, it's being channeled to silver and some of these other precious commodities as well. Now we look at gold here in the black line. Again, no, same story. Obviously the very strong performance in gold lately, but we overlay that with this other line, which is the 10-year TIPS yield, which is, so what's TIPS? That's Treasury Inflation Protected Securities. So these are Treasury securities that are indexed to inflation. And so here we have on the right-hand scale, TIPS are now essentially yielding about 2.1%. And so that's, for all intents and purposes, that's the expected rate of inflation that's being priced into the next 10 years. So basically 2%, close to the Fed's target. And we've come a long way in that regard. So, but you can see the relationship here is positive with gold prices. And when you have a inflation picking up, or inflation expectations picking up, you tend to see a little bit of a difference in gold price trends. And so what we have now is something that's actually very odd. We've had a massive divergence between gold prices and what would be implied by what we're seeing in the TIPS yield right now. We'll look at oil prices as well as other industrial commodities. You can see that we know from gasoline prices moving higher is, they're all a function being a distillate. They're all distillates from oil, from crude oil, and so we know crude's moving higher. There are some obviously geopolitical issues at bay that are helping to drive oil prices higher, but you're seeing it in all industrial commodities too. So, as you look at 2023, and from an investment standpoint, commodities didn't have a very good year at all, and you could see why, that they were moving south pretty much the entire year, but that has attenuated and we're moving back up north now. And just, whether you're talking about oil, you're talking about other industrial commodities like scrap steel, etc., or you're talking about the precious metals on the last slide, then everything is looking up so far in 2024. You can see here in this chart, everything's indexed to the beginning of the year here, and so as we look over basically what amounts to just about 4 months, it illustrates what I've been talking about with regard to the commodity basket. I mean, you've had whether it be crude oil, whether it be gold, whether it be copper, which is in that industrial metal category. I mean, they've all moved higher at a point where we've seen a little bit of a stall in some elements of the S&P 500, seen a lot more volatility in some of these Magnificent Seven names, and now I think they're maybe not even calling it that anymore. It might be more the Magnificent 5 or 4, or the Magnificent NVIDIA plus guess, or whatever they're calling it now. But clearly we've had some really strong performance out of commodities this year. Talk about money flows. What's interesting is not too long ago, we were talking like massive equity inflows. Well, that's reversed itself. So I think the amplitude of these waves shows you relative to pre-pandemic, right? We didn't have this amplitude that we've got now, but it just shows you that that there's a lot of speculation going on. There's a lot of investors trying to chase the caboose on the train as it's pulling away. And we've seen money flows, differences in money flows, which have been really, really strong. And if you look at weekly equity fund flows, latest reading was here, and you got the 12-week moving average right here in this gold bar, and you can see that that's ticking down at the same time that the weekly equity data is also negative. And so it's a very interesting trend. I mean, I think this is a magnitude. When you get down to like 15% change on either side, it can have a much more meaningful impact on the pace of overall equity prices. Now we look at valuation here, and as we've been making the argument for quite some time, you've had, in the blue line that represents large caps, and we do know that large caps have been dominated by a handful of very prominent technology stocks. And so we've seen cyclically adjusted PE ratios or CAPE ratios move higher here. But at the same time, in this red line here, this represents small caps. Their valuations have been going down. And it's not uncommon to see a little bit of a gap here. Obviously we saw that gap here, and at various points here, but usually, and for the most part, they move in the same direction. So it's actually really unusual to see large and small caps move differently, and you can see the relative PE ratio that gap is tremendous. I mean, we haven't seen that gap since the tech bubble back in the late 90s and over the turn of the century here. And so what this tells me is that small caps are certainly cheap relative to large caps, worthy of investment. But as we saw, before, smaller companies and especially smaller cap publicly traded firms just tend to be a little bit more prone to or subject to changes in interest rates. But if you believe interest rates are eventually going to come down, and maybe that's more of a 2025 phenomenon, as the estimates currently have it, then you want to be out in front of that with some kind of allocation to small caps. And here we have a chart again from the Bank of America Global Strategy Team. And basically what this tells us is that small caps typically do perform once you get that first rate cut. They tend to underperform, as they certainly have been in this cycle, leading up to that first cut, but obviously we don't know when that's going to be. Current estimates are probably July, but that could obviously change if we have another hot inflation print next month. But generally speaking, if you're patient and you get out in front of that rate cut and you make an allocation to small caps, tends to be rewarded within the next year thereafter. So interestingly enough, we've continued to focus on some quality elements within the market. Even though we do know that, some, I guess, call them junk or suboptimal type balance sheet companies have done quite well, but you can see here that just as you look, dating back for basically about a year, that you've had strong balance sheet and capital strength has outperformed their weaker components. So in this market, we do see quality continuing to outperform. Here we have an asset class risk return profile. This is an estimate. This is coming to us from Oxford Economics, and it's based on dollar-based returns. And it just kind of shows you on the x-axis here, we have annualized volatility. And so obviously the higher the volatility, the more risky that in particular investment or asset class is. And then on the vertical axis or the y-axis here, we have the 5-year annualized return. And so this is expected risk return profile. And so where you want to be, obviously with a high return with low risk. So you want to be as close to this quadrant that you can. So if you look at this and kind of reflect on asset allocation, well, you want to have some exposure to U.S. investment grade credit. You absolutely want high yield, which has been very strong lately. Oddly enough, kind of plowed right through this whole credit issue that we've been talking about. You want to have some international exposure, and this is emerging market local bonds as well as developed market bonds over here. And you want a diversified basket that has the ability to generate some higher returns over here. But here's emerging market equity. Again, probably not as favorable right now if you have a really strong U.S. dollar. But you've got U.S. equity here. The expectation is that you're going to have more muted performance over the next 5 years, at least by this estimate. And so if you assume 3.5% returns with average volatility of around 16%, which is not the volatility at least is not out of the realm of reason, or not out of, I guess what am I trying to say is this, it's not out of the ordinary for U.S. equities to have that kind of volatility, but usually you'd expect more in return for that volatility. It just goes to show you that having some diversification internationally, having some diversification to other asset classes is, I think, going to be imperative as you look over the next several years worth of investing. I took this from a research report from Richard Bernstein Advisors, RBA, do an awesome job. This is really more of a kind of a secular expectation. And so their big theme, at least in their March research report, was the investments in infrastructure and what they're calling the reindustrialization of the U.S. And they feel like these are not just attractive investment themes, but really just mandatory areas of growth that we have to. And I did a couple of cuts and pastes of this data, and you can see our trade balance continues to be really negative here. I'll call this better stated a trade imbalance. But the themes within that reindustrialization here are, basically we've got to invest in our energy infrastructure. And that includes other modes of energy, utility infrastructure. We know that well enough here in Texas, that the grid is antiquated and somewhat unreliable, which is a big issue if you've got a growing economy. Transportation, this is a pretty stark comment. We rank last amongst major economies in transportation investment. And then real estate, it looks here, obviously manufacturing, we'll have to make some reinvestments there once manufacturing gets back on its footing. And then steel and shipbuilding, and this is interesting coming at a time where U.S. Steel is looking to be acquired by Nippon Steel, a large Japanese conglomerate. But we're last among major economies in shipbuilding, which I have followed myself for quite some time. But these are infrastructure areas of need right now, and so feeling like when you look out not just over the next 2-3 years, but over the next 10 years, that you're going to have a lot of opportunities to participate in this type of spending based on publicly traded firms that are doing the work. That's all we have this week. Hope you've enjoyed it. Have a great week, and we'll talk to you again soon. Take care.